Welcome to this explainer. Today, we're diving right into the Happiest Minds 2026 Annual Fiscal Report. You know, navigating rapid tech shifts while somehow keeping margins steady is notoriously difficult, but Happiest Minds has engineered a truly fascinating story of disciplined execution this year. We're going to break down their top-line numbers, look under the hood at their operational engine, and see exactly how their big AI-first bets are actually paying off.
So, here's our roadmap for today. First up, the revenue and profitability scorecard. Then we'll peek behind the numbers at their operations, explore the AI-first advantage, and finally look at shareholder returns.
All right, let's jump straight into Section 1, the revenue and profitability scorecard.
The big question right off the bat, right? Did the company actually make money and did they grow? Well, the short answer is absolutely yes. Total revenue for the year came in at a massive 2,315 crore rupees. It's a huge milestone. But, as we know, raw numbers in isolation only give us half the picture. What we really care about is momentum.
And that 2,315 crore? That translates to a rapid 12.3% year-on-year growth, a really healthy clip. Now, just to be completely transparent here, the report does note that in constant currency terms, meaning if we strip out those annoying exchange rate fluctuations, revenue still grew by a rock-solid 9.2%. So currency tailwinds or not, this growth engine is clearly firing on all cylinders.
Let's see how this actually builds across their financial foundation. Operating profit hit 401 crore, which perfectly matches that revenue growth at 12.3%. But here is the absolutely crucial takeaway. Operating margins stayed remarkably steady at 17.4%. I mean, growing the top line is easy if you're just spending recklessly, right? But maintaining steady margins while you scale, that shows they are managing this growth incredibly efficiently. And that discipline cascaded right down to an adjusted profit after tax of 279 crore, delivering an earnings per share of 18.51 rupees.
Okay, moving on to Section 2, behind the numbers, focusing on operations.
You know, the financial scorecard is really just the result, but the operations, that's the cause. So how did they actually pull this off? Honestly, they executed a classic land and expand model flawlessly. They held on to a massive base of 306 active customers, giving them a super stable revenue floor, while still aggressively bringing 51 brand new clients into the fold. They're keeping the old while relentlessly hunting for the new.
But what about the talent doing the actual heavy lifting? Well, utilization improved to 81.4%. To put that corporate metric into plain English, over 81% of their talent is actively deployed on billable projects rather than just sitting on the bench. That right there is the direct driver of those steady margins we talked about earlier. And to top it off, trailing 12-month attrition dropped down to 17%. So they're keeping their teams highly utilized and, more importantly, keeping them from leaving.
Which brings us to Section 3, the AI-first advantage.
Because let's face it, in the tech sector, past performance is basically yesterday's news if you aren't positioned for tomorrow. Let's look up from the rearview mirror for a second and ask what is actually driving their future pipeline. With the absolute explosion of generative AI, client demands have completely shifted from where they were even just 3 years ago. So how is Happiest Minds capturing this shift?
The answer is right here, a massive 27% spike. Their sales pipeline grew by 27% in the final quarter alone. And the report directly attributes this incredible momentum to their AI-first strategy. By putting themselves right at the forefront of AI implementation, they aren't just selling your standard legacy IT support anymore. They are selling full-on business transformation. And that gives them a uniquely strong outlook for the next financial year.
All right, let's wrap things up with Section 4, shareholder returns and dividends.
We've covered the revenue, the operational discipline, and the AI pipeline. But what does all this disciplined execution actually mean for the investors' wallets? Well, the board recognized the strong performance and recommended a final dividend of 3.65 rupees per equity share. It's a really solid punctuation mark on the year, but remember, that's just the final payment.
When we actually combine that final recommendation with the previous payouts from throughout the year, the total dividend for FY26 hits 6.40 rupees per share. That is the ultimate proof of a profitable engine. A company can really only confidently return this kind of capital to its shareholders when they're backed by ironclad cash flow, steady margins, and just total confidence in their operations.
Which leaves us with one final, incredibly exciting question to ponder.
How will this AI-first strategy compound these numbers in FY27? We've just seen a year of highly disciplined execution, super high utilization, and a 27% pipeline growth driven entirely by artificial intelligence. If Happiest Minds can maintain those steady margins while converting that massive new AI pipeline, next year's report could be absolutely incredible. Thanks so much for joining me for this explainer. Keep learning, stay curious, and I'll catch you on the next one.